Hello, my name is Carlos McWhorter, CPA, and today we have an updated analysis of Meta. So we're going to look at their 2024 results, look at the amazing rate of return that they had this year, and see if that impacts what we think about the company as far as the quality of the business and the company's intrinsic value. So let's get into it. So right now, Meta is trading at $625.66 per share. And as we talked about last time, many people missed out, and I understand, but this was such an amazing buying opportunity. This is when Meta changed their name from Facebook to Meta, changed their strategy, their capital allocation just totally switched. So you're looking at a different business when they start spending money differently to build the metaverse, and people did not believe in the company anymore and they sold. But they quickly changed course. One thing about Meta, they were so successful with their ad business, with their apps, that even though they were spending this money and it pretty much went down the drain, they created so much cash flow with their main business, their ad business, they had enough runway to experiment and do this. So this does happen sometimes in a company's life cycle where they experiment, doesn't work out, and they change course. But when the top companies like Meta, Microsoft, Apple, when they do that, it doesn't hurt their business because they print so much cash every year with their operations. So we see that was a great buying opportunity. They're back up to $625 right now. So they're about $1.58 trillion in market cap with a beta of 1.23. So a little bit more sensitivity compared to the market, more volatility there. Trading at a PE of 26 times earnings. So $26 for every dollar of the company's earnings. That's the rate of what you're buying when you buy this company. So let's get into revenues. Revenues and margin trends. So 17.9 billion all the way up to 164 billion in revenues. Positive growth and double-digit growth every year except for 1 year. And that's that year that they were kind of looking at the strategy change. So that 1 year, 22, revenues went down from 117 to 116 billion. Not a whole lot. A 1%, negative 1% there. But as you see, they rebounded with 15 and 21%. So amazing revenue growth. Last 5 years, 19.1% growth. So we like that. Margins, 84% in 2015, 81% in 2024. So still very high margins, but noticing they were in the 84 to 86% range, and they've kind of dropped down to that high 70s, low 80s here. Still solid, but the company isn't as efficient as it was about 10 years ago. So not an alarm, but we do notice it. Let's look at net income. Let's look at the profitability of the business. 3.6 billion to 62 billion in 24. Amazing growth, 59% change or growth in net profit. And the year before that, 68%. So they did have negative net profit growth. So, they had profit in 2022, but of course it went from 39 to 23. So it was down 41% that 1 year, but they rebounded with an amazing 68 and then another amazing 60% return or growth on their net income. Amazing. Margins, 20% up to the 39s. Okay, back up to 29 to 37%. So great net profit margins. Not a straight line, kind of up and down here and there, but 38 cents out of every dollar that comes to the door is their bottom line. Not just their gross, but their bottom line. So that's a pretty amazing margin. Of course, it's a tech business, so you do expect solid margins like this from an established tech company. So let's look at the free cash flow. 2015, 6 billion, 2024, 54. So solid growth, only 2 years where it was down. Let's see, 2018, and of course, 2022, as we've seen with revenues and net income. But again, after that negative year, 130% growth, and then another 23% growth, which is great here on free cash flow. So things are looking good. You just had that 1 year, which appears to be an anomaly, but looking at all the other metrics, that 1 year was negative, or still a good year performance-wise, but just wasn't growth that 1 year. So let's look at the debt. We want to compare the debt to the free cash flow. How quickly can this company pay off its debt with the cash that it generated this year? So averaging to be at 0.9 debt to free cash flow. That means it takes this company, or they produce enough cash to pay off their debts in less than 1 year. Only 1 year in 22 when they had their, for them, a bad year. 1.3 years to pay off their debt. Still amazing, still well under 3 years. However, that's their worst year that they've ever had. So they've always stayed in a great leverage position since 2015. And even 3 of those years, they had no debt. So amazing leverage position there. No issues. Let's go to the dividend, because Meta now pays a small dividend. So 0.24% yield, so very small. They pay 50 cents per share every quarter. So that's $2 a share annually. And only 9.4% of their cash flow is being paid out in form of a dividend, which means this company has a ton of runway to continue to grow their dividend. Now, Meta is a tech company that makes acquisitions, and they also create new things in their app. So they're going to spend money, a lot of this cash flow, back into their business to continue to build their platform and develop and to be competitive in their, highly competitive space with all these social media apps. However, you should not expect Meta. I would not want Meta. I'll say this. I wouldn't want them as a shareholder to grow this dividend at a high rate, because they have so many opportunities to take that free cash flow, put it back into the business for high returns. So they are paying a dividend, which is great. They can afford it easily. I don't want to see them grow it at a fast rate. So this is not a stock that I would say is a dividend growth stock. I want a dividend growth stock to be a company that's more established, doesn't have many opportunities to reinvest in the business and expand. They kind of have a solid market share, and they're kind of settled. So maybe like a Home Depot or Dick's Sporting Goods. Those are the types of companies where I'm looking for them to grow their dividend, because what else you're going to do? You're a retail store. You don't have any other service lines. You do what you do and that's it. But when it comes to these tech companies, Amazon, Meta, Google, there's so many more opportunities in the tech space for them to continue to grow. So it's smart for them to not pay out a large dividend and to have that cash ready to reinvest back into the business whenever it's necessary. So I think right now what they're doing is fine with the dividend. We'll see how it grows in the future. Again, I don't want to see this grow too much because of the type of company it is and the opportunities that they have. But right now, solid. Shares outstanding. This is something else that they do with their free cash flow. They either pay a dividend or they continue to repurchase shares and reduce the number of shareholders who own the business. So as a remaining shareholder, every time they buy shares and reduce the share count, your share owns more and more and more of the business. So we love to see companies do this. So as you see, they are buying shares at a great rate, pretty rapid. So that's amazing to see. No complaints there. Now let's look at the economic value added. I want a company to earn a high return on capital, and I want it to be higher than their cost of capital, their interest on their debt, and the potential opportunity cost to holding capital and putting it to their business instead of the market. So with that said, they have a return on capital of 18.5% over the past 5 years. Their cost of capital over that same period, 8.9. So they are creating value at a solid rate. So the capital that they have on hand, they are returning about 10% per year. So this company economically gets better 10% a year based on these two numbers on average. And we love to see it. That's a great spread right there over the cost of capital. Now, with that said, let's look into the valuation of the business. So I'm assuming that where their cash flows are right now, they can grow it at about 17% per year for the next 5 years. The discount rate, weighted average cost of capital. Also, in 5 years, I expect to be able to sell Meta, if I were to buy this stock, for at least 25 times cash flow. The market cap would be 25 times their free cash flow. Right now, they're trading at 29 times free cash flow. And I don't think they're super highly overvalued right now. So it's reasonable to think that I can sell this for 25 times free cash flow in the future. I believe that is a solid metric for high quality tech companies. So with that said, I estimate that Meta is worth $755 per share, right now trading at $625, upside of $129 or 20.7%. So I'm estimating that this stock is undervalued and has a lot of, I wouldn't say safety right now, because we never know what the market's going to do. Even though I think it's undervalued, and let's assume I'm right, the stock can still fall. So we aren't saying that this stock is necessarily safe with the current state of the market. But as far as the Magnificent Seven, I believe this is probably the stock that is either the only one that's undervalued, and definitely the one that's undervalued at this rate, at a rate of 20%. So in my estimate, I personally believe this company is undervalued. The intrinsic value is around $755. So let's look at a quick summary of what we just reviewed, and it'll be real quick because there's not really many issues. So basically, they checked every box that I have, except for that 1 year in 2022 where there was some negative growth. But again, they bounced back at a great rate and pretty much doubled their normal growth rate for those years. So all checks, all good. So that, I believe Meta is a great quality business. If you're not comfortable with this price, this is definitely a company to put on your watch list. But this is just my assessment. I think it's worth about $700 and I believe $25. So definitely 20% upside is my estimate in Meta right now. So hopefully you enjoyed this review. Let me know what you think in the comments, and I hope to see you in the next video.